Welcome back to Chip Stock Investor for our earnings rodeo. Today we have Texas Instruments and Alphabet. Nick, why don't you kick us off?
Appropriate. Earnings roundup, Texas Instruments. Let's get started with TI's earnings.
Okay. The only thing I know about Texas Instruments is the TI-83, which I used in algebra, and I hated it.
Okay. You hated algebra. What about the speak and spell? Did you ever get to use the speak and spell as a kid?
I did, and that's way more my speed.
Okay. All right. That's a TI. That's an old TI product.
Okay.
But TI is not really a consumer products business anymore. So they are an industrial chip manufacturer. That's really what they're known for, is they're an integrated device design and manufacturer. One of the few that still has extensive fabrication operations here in the US, and they're expanding those. Like in Sherman, Texas, there's that new TI factory in Sherman, Texas. We know Sherman,
right next to 903 Brewing.
Shout out to 903, north of Dallas. Check them out. Okay, enough of that. Let's talk about the numbers. Kasey, why don't you read the Q3 headline numbers here?
Okay, so the Q3 revenue was $5.24 billion compared to $4.64 billion in the third quarter of last year, which is a 13% year-over-year increase. And then the net income was $2.3 billion compared to $2.35 billion, which was a 16% change.
So really solid quarter.
Yeah, absolutely.
Yeah, nice growth for Texas Instruments here. So this is not the most exciting semiconductor business around. Texas Instruments focuses on what you could say less than the most technologically advanced chips out there in the market. Most of their products are analog chips. So that's a device that interacts with some sort of real world signal. It might be audio, it might be visual. A lot of their stuff goes into industrial applications or automotive versus a digital chip. Check out the Moore's Law videos we did before on that. A digital chip interacts with all those ones and zeros versus a real world physical signal. One of the reasons TI is such an attractive investment is there is that 3.2% dividend that the stock pays, but they also have extra free cash flow. That's profits cash that they generate from their operations. They always have additional free cash flow after they pay the dividend. So TI historically returns the rest of that free cash flow via share repurchases. So that's the bigger increase in earnings per share over net income. That's a nice bonus. This is a highly profitable semiconductor company, and it's probably going to get a lot of benefit from the recently passed U.S. CHIPS Act to support manufacturing in the coming years.
So Nick, I know we don't own Texas Instruments stock, and I know you kind of have a hang up about companies that return cash to their investors versus reinvesting that cash into growth.
Right. It's a balancing act, especially for a technology company. There always has to be this balancing act between being highly profitable, which Texas Instruments absolutely is, one of the most profitable semiconductor manufacturing companies on the planet. And they return all that excess cash to shareholders. But it has to be balanced with investing in growth, which TI has done a fantastic job with, reinvesting it back into manufacturing, getting more efficient. But there can be some issues with that. So far, this has been okay for TI because they focus on technology that's not necessarily cutting edge. But I'll just point out, back in the day, back in the 70s and the 80s, TI employed someone named Morris Chang, moving through the ranks at Texas Instruments, getting disgruntled, as he says in a historical interview, getting put out to pasture by the company. He got tired of working at Texas Instruments and went on to found the company we now know as Taiwan Semiconductor Manufacturing. Biggest chip maker on the planet. How might history have been different had TI not put Mr. Chang out to pasture and kept him there at Texas Instruments. So if you're looking for a dividend stock, a highly profitable semiconductor business, I think TI is a fantastic stock to buy and hold for the long run, but never going to be that exciting. Just bear that in mind and know that there's always going to be this risk that TI eventually maybe falls behind the curve because they're not investing in the newest, latest, greatest technology.
Okay, Nick, let's move on to the chip stock plus portion of our show today.
Okay, enough of my rant on TI, sorry.
Yes, we're cutting you off. So now let's move on to Alphabet or Google.
Mm-hmm.
So the reported revenue growth was 6% for Alphabet this quarter, which excluding currency exchange would have been 11%, right?
Right. So basically, because the Federal Reserve has been hiking interest rates at a record pace this year, that is strengthening the US dollar against foreign currencies. So this is actually happening not just to Alphabet, but any company that does international business. When they exchange a foreign sale back into dollars, it reduces the value of the revenue. It gets worse though, because Alphabet and other tech companies, once they convert that money back into dollars, they expense most of it, like on research and development, in the United States. So it has an even bigger effect on profitability at this point. They grew revenue 6% year over year, but that equated to only a 25% operating profit margin versus 32% during the third quarter last year. Still with me?
I think so.
Okay. Basically, I guess what we're trying to say here is Alphabet looks like it had a super ugly quarter, and there were some issues. They hired too many people, it looks like, in the third quarter. Their headcount growth exceeded revenue growth. That being said, they are planning on scaling back hiring in the fourth quarter and in 2023. And the dollar is not going to just continue skyrocketing for forever like it has. Eventually that will cool off, hopefully sometime early in 2023 when the Fed eases off its interest rate hikes. But that's why it looked like Google had such an ugly quarter.
So basically, Alphabet's 6% revenue increase equated to a 24% decrease in earnings per share.
Correct.
And most of this is caused by rising interest rates, correct?
Basically, yes. It's a side effect of rising interest rates.
Okay. So is it time for us to sell our Alphabet stock?
Good question. So we've been purchasing Alphabet throughout 2022. In hindsight, the wrong call, but I think we're going to still continue purchasing Alphabet stock.
I do use Google a lot.
Yeah, as do I. There's also Google Cloud, which is still growing at a brisk pace. It's not profitable yet, but it's getting there. That could be a really, really big benefit for Alphabet. I think in, say, 5 years' time, I think we'll look back at Alphabet under $100 a share and say, wow, wish I had bought more. But that's just my opinion. I think that's how you and I are going to operate going forward, but I don't know. What are your thoughts?
We all use Google products. And on the earnings call, they mentioned how many people are using Google Lens, how vast that search library, that the language capabilities are, the deep AI portion of the business. There's a lot of really cool stuff that Google is doing. So I say buy more.
Yeah, buy low, sell high. Yeehaw.
Earnings rodeo.
Okay, you heard the girl. That'll do it for this segment of Earnings Rodeo, third quarter 2022. We'll have more earnings rodeos coming to you here soon. So stick around. Make sure you hit subscribe, hit the bell so you don't miss a video. See you next time.